Well, greetings and salutations, Series 7 test takers. This is the Series 7 guru, Dean Tenney, coming to you from my studio here in fabulous Las Vegas with episode 9 of our Series 7 exam podcast series. This one is on customer accounts. We've only got a couple more episodes left in the playlist for this podcast. And today we'll be in function 2. You open an account. You obtain and evaluate customers' financial profile and investment objectives, which on your Series 7 is 11 questions. We've been doing the podcast series in terms of weighting, but the content outline, job functions are function 1, find a customer, function 2, open an account. That's today's episode. Function 3, make an investment. We finished function 3. That's 91 questions. And then function 4 is what happens after the trade. So we did function 3 because that's 91 questions. We did function 4 because that has more questions than function 2. And we'll do function 1 is our last episode, or episodes, depending on how much content is there. All right, so let's talk about the various different types of customer accounts. I will also link in the pinned comment and in the video description to my full lecture on customer accounts, as well as any other lectures or videos that I think might help expand what are these podcasts, right? This is to listen to on the drive to work or while you're in the gym, or so I don't want you to think these podcast episodes are a substitute for the full lectures, reading your book, doing your practice questions, all that other stuff, right? All right, so the first thing we're held accountable for is a pattern day trader. The definition is testable, and then what is their minimum equity? So a pattern day trader is a trader who executes 4 or more day trades within 5 business days using the same account. I always am wondering, like, oh, excuse me, it looks like I'm going to have to sneeze here. I'm allergic to day trading. I always wonder, like, how many customers at Robinhood, for example, might not know what triggers this definition of a pattern day trader. And the point is, well, once you are a pattern day trader based on that definition, you're required to hold 25,000 in your margin account. Prime brokerage. Prime brokerage is a service offered to institutional investors, primarily hedge funds. Whereas a broker dealer, I provide custody and financing for the hedge fund. What that allows them to do is business around town without setting up a whole bunch of different accounts. So, for example, if I'm a hedge fund and I do a trade with an institutional broker, PTIG, I say to PTIG, I say, listen, if you have some good ideas, feel free to present those to me, because nobody has a monopoly on good ideas. And if I do that trade, I will execute through your broker dealer, so you can charge me markup, markdown, or can charge me a commission. I'll make sure you get paid. However, I don't want you to hold my monies in securities. I do business all around town. And so when you settle up with Goldman Sachs, my prime broker, they provide me with custody and financing. The idea here is I get one centralized statement rather than getting, statements from the 10 different broker dealers I do trades with. Delivery versus payment, or receipt versus payment, or receipt versus payment. There's no testable distinction between the two. It's very similar. This is where, as I say, as an institutional, again, customer, I don't need you to hold monies and securities for me. I use a commercial bank for that, State Street Bank and Trust, for example. So when I do a trade with you, I would like you to deliver that to State Street versus payment. Delivery versus payment. Again, I'm providing the commercial bank is holding my monies and securities for me. I could do that for privacy, right? Because, I don't want you maybe to see the other assets. Again, I don't have a bunch of different statements. And if you get this as a test question, low probability, I have up to 35 calendar days to settle that trade. It's not going to take me 35 days. Nobody does, because I want my money and I want it now. But, it comes from a time in the past when, things weren't quite as electronic. You say, hey, Dean, I'm not really, a fan of the traditional business model of a stockbroker. I said, what do you mean by that? The traditional model as a stockbroker is the relationship you have with me is free. As part of that relationship, I make recommendations to buy or sell securities. And if you buy or sell the security, that's how I get paid. So the relation is free and you're paying for the transactions. And you say, well, Dean, I'm afraid that you might tell me to do something just to generate a transaction, a commission markup or markdown. I said, well, I hope I'm ethically not challenged by that. If the answer is do nothing, I hope I would tell you do nothing. That would be the end of it if I have a 663 or 763. But I say, hey, did I tell you I'm duly registered? I'm not only registered as an agent for the broker dealer, I'm also registered as an investment advisory representative of our affiliated investment advisory firm. And we do offer wrap accounts where we can wrap the products and services of the broker dealer as well as the investment advisory fee into one account. Now, there's a couple test questions here. The first is I have to give you a brochure that clearly tells you what's included and excluded in that wrap fee. The second test question would be I have to help you make a decision that's in your best interest. So maybe I tell you, hey, I've done some homework here, and you would save some money to take advantage of our wrap account. And then you tell one of my clients, and then that client says, Dean, why didn't you tell me about the wrap account? I said, well, when I did the homework on your account, you're better served to be buying a la carte and paying for transactions. That ends up being less than what the wrap fee would have been. We have individual accounts, for individual natural persons, living, breathing human beings, walking planet Earth, pretty straightforward. And again, that suitability would be pretty easy because it's just the suitability of whoever this individual is. Now, that individual might want to add to their account, test question, transfer on death. So when they die, we're going to transfer these assets to the beneficiary. And the advantage to this account is it avoids probate. We certainly have to be able to distinguish between joint tenants with rights or survivorship and tenants in common. I made a little short about I see death everywhere. There's lots of questions about what happens when people die. Transfer on death is an example of that. Another example is, when you die and you inherit securities, there's a step up in the cost basis. So anytime somebody's dying, you probably should, say, oh, I probably pay attention to that. Anyways, in joint tenants with rights or survivorship, the decedent share, there's no fractional interest, and the decedent share goes to their surviving party, and they can continue to transact in the account. So with joint tenants with rights or survivorship, the decedent share goes to the surviving party, and they can continue to transact. Whereas in tenants in common, and that's what you've got to be able to do, is contrast. In tenants in common, there is a fractional interest, 80-20, 50-50, whatever the case may be. And the decedent share goes to their estate or to the beneficiary. And when they die, the account is frozen, right? So the other tenant cannot transact in that account. What we're going to do is await the proper legal instructions, and we're going to freeze the account. Requirements for opening a opening customer account. So, the general securities principle is the one who accepts or signs the new account form and accepts that account on behalf of the broker dealer. And there may be additional documentation or requirements to open the account. And we're going to be talking about some of those. So if we're going to open a retirement plan or other tax advantaged account, there might be some things we need to know about it. Eligibility, what are some of the rules about that? And one of those is the individual retirement account. And to fund an individual retirement account to be eligible, you need earned income. So they like to kind of ask you on the test, like something, can I fund an IRA with dividend income I'm receiving from my stocks or interest I'm receiving from the bonds in my portfolio? And the answer is no. Now, there's exceptions for a non-working spouse, but the test point is to know you need earned income to fund that. You should definitely know 59.5 for most of these. But I mean, not just individual retirement accounts, variable annuities, any other type of account. That 59.5 is when you can choose to draw down. And when you draw down, everything is taxed at ordinary income tax rates. And then there's a 10% penalty for early withdrawal. So fly high here. Don't get too much in the weeds on some of these retirement plans. But the things I'm telling you to be aware of, you should certainly be aware of. There's required minimum distributions at 73. The IRS wants to make sure that they get their hands and get to tax that money. And so they want to make sure you don't check out before that money has been withdrawn. So at 73, there's required minimum distributions. That's what RMD means. Now, one testable contrasting point is that is not true of a Roth. I always joke Senator Roth is no longer here to protect his IRA. When you're a senator and you come up with the idea, we name it after you, and this is called a Roth IRA. And one of the nifty things about a Roth IRA is there is no required minimum distributions. If you roll over your retirement, your IRA from A to B, or you roll over your 401k to an IRA, whatever the case may be. Rollover means you're taking physical possession of the assets. Physical possession of the assets. I'm not going from custodian A to custodian B. I'm calling you as my broker and say, hey, I'll be in late next week, liquidate all my investments, have a cashier's check for me. The test question there is a rollover has to be done within 60 days, right? If I don't get it back in the appropriate spot within 60 days, it's a distribution. And again, that would be that 10% penalty. Inherited IRAs are starting to show up on the Series 7 as a test item. And so when you inherit an IRA, the spouse of the surviving spouse can roll that over to an IRA or part of the IRA into their own existing individual retirement account. And by doing so, defer the required minimum distributions until they reach the age of 75 or 73, excuse me. So the spouses have some advantages in terms of this inherited IRA as compared to, and the test point would be the comparison to somebody who isn't a spouse. So an inherited IRA, also known as a beneficiary IRA, is an account that is open when an individual inherits an IRA or an employer-sponsored retirement plan after the original owner dies. And if they're not a spouse, what we need to know for test purposes is if it's non-spousal beneficiary, they have to empty that, distribute that within 10 years. We talked about Roth. We said you definitely need to know that a Roth IRA is being funded with after-tax money you've already paid taxes on. So you're not going to have to pay for taxes when you get that, right? No RMD. And again, if you're 59 and a half, you can get tax-free withdrawals, which is kind of cool. Of your questions here, variable annuities are considered to be non-qualified retirement plans. And what we mean by non-qualified is not qualified with the IRS. And what that means for us as test takers is that we're using in a variable annuity after tax money. So what we're contributing to the variable annuity is our cost basis. And then that money is going to grow tax deferred. And again, at 59 and a half, we can get, annuitized life only. In this podcast episode, I'm not going to go over, the handful of potential test questions, but I will link to a lecture on variable annuities that has everything you need to know about variable annuities for test purposes. I gave you a couple already, cost basis. I think you'd be doing yourself a great service if every time you hear the word variable annuity, you just translate mutual fund with insurance wrapper. And, you shouldn't be funding a variable annuity unless you've maxed out every other retirement plan available. And so there are heightened suitability in terms of recommending a variable annuity. I told you money's growing tax deferred, and then you can either get a random distribution, very testable to know that's going to be LIFO, last money's in, first money's out. You can annuitize. The test question there is what would give you the largest monthly payment, which would be life only. And then I will link to that lecture for you. 457 plans. I think you're more likely if your next leg of your testing journey is a 66. I think it's more likely you're going to see 457s on the Series 66 than you will on the 7. I mean, they're there. It's all about probabilities. And a 457 on the 7 is low probability. But if you do get this question, what you need to know is it's not. It's an IRS sanctioned tax advantaged retirement plan. And then tax advantaged in its IRS sanctioned, but it's not qualified. It's not covered by ERISA is the point. So here when we say a 457 is non-qualified, we mean it's not subject to the Employee Retirement Income Security Act. And then the second question would be to know that this plan is offered only to public service employees and employees of tax-exempt organizations. What I think of here is policemen, firemen, people that work at the city. Is that how I kind of think about this? You're going to get asked to contrast a 529, a municipal security. The MSRB, the Municipal Securities Rulemaking Board, says it's a municipal security. It's a municipal security. And you're going to have to contrast 529s with Coverdell. I kind of think of it as a beauty contest. And what you need to know is that the 529 is always going to be the winner, for lots of reasons. For example, Coverdale's, educational IRAs, is 2 grand. I mean, how much college education can you buy for 2 grand? Not a lot. It's means tested. That's not good. The 529, there is no means test to it. Anybody can fund a 529. You can front load this with, 5 years without running afoul of the gift tax. You can put a lot more money into 529. And then it grows tax deferred. You have investment risk. Then you can withdraw for qualified educational expenses. The main point is just to know. In fact, a lot of people tell me that their financial institutions don't even offer Coverdales anymore because they're just not competitive in today's marketplace. And then you have 2 versions. I just told you one. I'm coming in from Nevada, and our Nevada 529 is managed by Vanguard. So, I put 5 times whatever the gift is. I think this year, I think it's 16.5. They don't get into numbers that change like that. Anyways, whatever that number is, I could put that into that Vanguard fund. It would grow tax deferred. Now, the other option is I could buy a prepaid plan where I just buy a bachelor's degree. Now, if you get the question between the distinction would be in the one where I'm putting into this Vanguard fund, I have investment risk and I have inflationary risk. But the point is the prepaid plan does not, right? Because I'm just buying a bachelor's degree off the shelf. Well, it happens, right? We lose an account. So, my customer is leaving. He's going to another broker dealer. So we're going to fill out the transfer instruction form, the TIF, and then we use the automated customer account transfer system to get this done. And the test question here is we have 1 business day as the old firm to validate and 3 days to transfer. And that is indeed very testable. ERISA stands for every ridiculous idea since Adam. No. I'm joking. It stands for the Employee Retirement Income Security Act, passed in 1974. And there were 2 major crises in the private pension plan arena. This doesn't cover public pension plans. Municipalities, that includes states, remember on this test, are municipal issuers of securities, are one of the few employers that are still passing out old-fashioned defined benefit plans, where we, your employer, tell you after X number of years that you're going to get a percentage of your base pay and health care for the rest of your life. And for example, the state of Illinois has a huge unfunded pension liability. They've made these promises to the current employees of the state of Illinois and future employees of the state of Illinois. And if there was ERISA doesn't cover municipals, it's private pension plans. That's testable. Think corporations here. ERISA would require them to fund that and make good on the promises. As I said, the 2 major crises in the pension arena, private pension arena, that triggered ERISA, behind every act there's a story, was the Teamsters kept lending their pension money to the mob. We didn't think that was a good idea. I joke Jimmy Hoffa is the first one who turned down a loan request from the mob, and we haven't seen him since. Secondly, was Studebaker was an automobile manufacturer that went bankrupt, and all the retirees and the employees did not get the benefits they were promised. So Congress passed ERISA, and it's about, again, protections. It's about protections to the retirees as well as the people who are currently working there, right? When you think protection, you think, making sure there's not adverse interest of people involved in the pension plan with the plan itself. Think, Jimmy Hoffa's nephew here, Defined benefit employee, these are the 2 basic types of plans. As I've said, not many employers anymore hand out defined benefit pension plans, but here the employer assumes the investment risk, right? You as an employer are getting a check. I'm coming to you from Nevada, and mom goes to play cards at the senior center, and a lot of those senior people she plays with are retired here in Las Vegas, and they are collecting on a defined benefit pension plan. They were promised a percentage of their base pay and health care for the rest of their lives, and that's what they got. Not many employers are doing that anymore. Most employers nowadays are using what we call defined contribution plans, where the employee assumes the investment risk. Right? The one that most people are familiar with here is a 401k. Right? That's a type of defined contribution plan. It's almost impossible for the employer to have an unfunded pension liability if it's a defined contribution plan, because what I'm defining to you as your employer is what I'll contribute. Maybe I'll say I'll match you dollar for dollar on the first 3%. You invest it, whatever that money grows to or falls to, that's what you get. Now ERISA would tell us that we have to tell you how you become vested. At one point is the match going to be, yours, so to speak. Non-qualified deferred compensation, known as deferred comp. This is compensation that has been earned by an employee but not yet received from their employer. So the employer kind of likes this, yeah, particularly for high-end employees, right? I mean, if you're a high-end employee, I always think you're like Jamie Dimon at JP Morgan or Brian Moynihan at Bank of America. You're going to max out that 401k pretty quickly. And you still might want to be able to try and replace the income you're presently making. And so the employer says, hey, we have deferred comp available for you. And if you'd like, you can defer that compensation to a later date. And that would be invested. And, it's good for you. It's good for the employer. Those are the advantages, right? Now, the point here is this can be discriminatory. In other words, we can allow some people not to participate. So, Jamie Dimon's and Brian Moynihan's 401k looks exactly like every other employee of Bank of America or JP Morgan, but not true of deferred comp. I say, how about deferred comp? We say, well, that's way north of where you're at right now. So this is typically for our higher end employees, think here corporate officers, the C-level officers of the corporation. Account registration changes and internal transfers need to be documented, right? So, boy, everything needs to be documented. You almost always got to think at some future date, somebody's going to be looking back at this moment and making sure everything was properly documented. Account registration means like, the wife calls and wants to take the husband off the account, the registration, or vice versa. Husband calls, wants the wife off there. Right. Or, husband wants to take money out of the joint account and put it in the personal account, internal transfer. All that needs to be properly documented. Usually I wouldn't struggle with this. That documentation would have to be signed off by a branch office manager or principal typically. Customer identification program. We need to know you are who you claim to be. And so all broker dealers in their written supervisory procedures have to have a customer identification program. Right? The WSPs is huge, right? So we ask every new hire to read the written supervisory procedures of the broker dealer. There's going to be, insider trading in there, customer identification program, how we protect seniors from exploitation, all this stuff. And then you're going to sign that you read it and you understood it, acknowledge you read and understood it. And that way later on, if you say, well, I was on my Series 7. I said, well, whether or not it was on your Series 7, it certainly was in our WSPs. We'd have a section on social media, what would be acceptable or not, all those kind of things. For us as test takers, what we need to know is we need a picture ID. Picture ID would be proof that you are who you claim to be, right? Military ID, driver's license, passport, whatever the case may be. I say for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I'm going to be determining suitability. And he said, well, Dean, it's none of your damn business. I go, well, actually it is. My regulators require me to know my customer, KYC. So, this data gathering I'm doing is very important on this new account form. I want to make sure that I've dotted every I, I've crossed every T. So test question, I'm going to send you 30 days, a copy of it. I'd like you to look it over and make sure I got everything accurately. If anybody changes this documentation, that true will trigger to you another thing saying, hey, your account has been changed. Was this you? We realize that your financial circumstances could change substantially over time. So we're also going to send this out every 36 months just to have you review it. And if there's any material changes, let us know. Again, in terms of customer accounts, we need to make sure you're not a corporate insider. Because if you're a corporate insider, there's all kinds of regulatory framework that shows up. So a corporate insider is anyone who can influence the decisions of a corporation and their immediate family. So that would be a director, a senior officer entity, or individual that owns more than 10% of the voting shares, right? So the big thing to know is that if you say yes to that on the new account form, then we need to know that you're subject to the volume limitations of 144. You're subject to the short swing profit rule, which is 6 months, right? So there's all kinds of things that triggered by that. If I'm not an officer, I'm not a director, I'm not a principal stockholder, I could dump that stock anytime I want. So again, that would be an important question. If you're an employee of a broker dealer, kind of a red flag that you're an employee of a Schwab and you're opening an account at Fidelity, for example. So Fidelity is going to make written notice to Schwab that you're attempting to open an account at Fidelity, and then Fidelity is going to follow any instructions from that broker dealer Schwab. Now, remember, house requirements can always be more stringent. So what that means is, I think the vast majority of firms say, forget it, you're going to have your account here. So please note, house requirements can always be more stringent than any rule we ever discuss. They just can't be more lenient. They just can't be more lenient. So, we're in function 2 here, customer accounts, and, we just kind of finished working our way through 2.1. And 2.2 is about obtaining and updating customer information and documentation. That would include required legal documents. What we have in mind here, it's a partnership. We need a copy of the partnership agreement. If it's a corporate account and they want to do margin, we need a copy of the corporate charter for both the partnership agreement and corporate charter to make sure that's specifically permitted. Same thing for a trust account. We need a copy of the trust agreement. If they're going to be doing things, make sure it's specifically permitted. If it's a partnership, we need a partnership resolution, which partner at the law firm is going to be able to make investment decisions, transact with the broker dealer, which corporate officer. You get the idea here, right? And then also about escalation for suspicious activities. Right. Remember this? We have suspicious activity reports. It looks like my banner is missing a couple letters there. But one thing that a lot of us like to do is cross solicit. And if we're going to cross solicit, what an end of an era. Merrill Lynch says they're no longer training brokers how to make cold calls because they just think cold calls aren't an efficient marketing technique anymore, and that there's all kinds of opportunities for cross solicitation of Bank of America customers. So Regulation SP is about, that kind of thing, sharing private information. Obviously, we're not supposed to share your private information without your permission to do so. And if we want to use that information, first, what are we doing to protect it? And then secondly, if we're going to use it internally, well, then, what are those? You make it easy for you to opt out and say, no, I don't want to be, cross-solicited. So again, one of the trick questions on privacy disclosures, remember, is we're not talking here about the government. So, if the government sends me a subpoena or something as a broker dealer, I'm going to honor that. But other than that, I'm not supposed to be compromising your private information. I can't tell you how many brokers I see break this rule all the time, talking about who their clients are. If I'm going to do that, I need permission. Like in my tutoring business, I tutor some very, high-end people. And, every once in a while I'll say, hey, would it be okay if I tell people I tutor you? I have to ask permission to do so. Comes up on the channel too. People go, oh, you've got people on the channel. And, I get permission to do that, right? I say, hey, would it be okay to share this? And you can either say yes or you can say no. Financial factors relevant to assessing the customer's investment profile. Here again, accreditation. This idea, or do you have $1 million net worth exclusive of your primary residence, or do you make 200,000 for the last 2 years, expectation of that this year? Or if you're married and filing jointly, 300,000, right, to make sure whether or not you can be invited to participate in a Reg D private placement. Tax bracket would be helpful so we can know whether or not you should be buying taxable bonds or tax-free bonds. Customer balance sheet would be very helpful. I say, hey, what I like to do to help my clients is figure out where we're at. Let's take a picture in time today of where you're at. Could you tell me about your current assets, your long-term assets? Tell me about your current liabilities, your long-term liabilities. Let's establish your net worth. Right now, that net worth is important, right? Because it might be part of this idea of $1 million, right? And again, every firm has different ways of verifying this. When I was a practitioner, to be honest with you, I was pretty loosey-goosey about this. But, some firms could, ask for W-2s or 1099s or run a credit check, whatever your internal firm wants to do to verify accreditation and sophistication. Your investment objective is very important. What I used to do as a practitioner, I'd say, hey, listen, I'd like to read you a list of investment objectives. I'd like you to rate them on a scale of 1 to 10, 10 being very important, 1 not important at all. Are you with me? I say preservation of capital, safety of principal, 10. Income, 10, growth, 0, speculation, 0. Yeah, maybe I buy you a AAA tax-free muni bond fund. Now, usually we don't test you on recognizing what would be suitable, but rather what would be clearly unsuitable given somebody's investment objective, right? The test varies negative. What I mean by that, for example, is I don't write naked calls if you're in safety of principle, right? I'm thinking treasuries there. I don't, if I'm thinking liquidity, I toss out partnerships. So that's why that function 3 is so important, because that links to both what investment vehicle will help you in terms of accomplishing your financial or your investment objective, and what would be an impediment, what would be unsuitable given that, right? So again, income, I'm thinking dividend paying stocks, bonds, things like that. So make sure you, that's a big time test. Here we're just talking about types of customer accounts and the information we're getting from the customer. But remember, that bleeds into this discussion of then what would be function 3, right? Because we're doing function 2 based on function 2, that leads into the discussion of function 3, which is the 91 questions on investment vehicles, right? 20 plus or minus on options, 20 plus or minus on muni bonds, 20 plus or minus on mutual funds. Account authorizations, we have a power of his attorneys, remember. I talked about getting the proper trust documents. I talked about getting a corporate resolution. Now, the power of attorney, again, is trading authority. And whether that trading authority is a third party, a particular partner at the partnership or particular corporate officer, or whether that power of attorney is the broker on the account who has trading authority, we definitely need to have additional documentation for discretionary accounts. So if I come to my manager and say, I have a discretionary account, my manager says, oh, no, you don't. You don't have a discretionary account until I, your principal, approve it. Have you done any trades yet? I'd better say no, right? So I have to have that documentation in place. And then separately, remember, this is the idea of full versus limited power of attorney. With full power of attorney or full trading authorization, not only can I make investment decisions on your behalf, I can withdraw monies and securities. With limited power of attorney, all I can do is trade your account, make decisions about action, asset, amount. There's 2 versions of this: durable, non-durable. Durable survives your legal incapacitation. I still have a power of attorney on you. Non-durable does not. And then remember, all powers of attorney cease upon death. And I told you, death is always big time test fodder. Well, it looks like we made it on our 30 minutes. We're trying to keep these podcast episodes at about 30 minutes. And so I hope you found this helpful. We've got maybe one more episode or 2, depending on function 1. I haven't actually laid that out yet, but we will be doing that, and that will conclude the podcast series. So remember, inch by inch, your Series 7 is a cinch, yard by yard. Your Series 7 is hard, and I'll see you for episode 10 in the near future.